Hi, this is Dan Collins for Traders Exclusive and the Dan Collins Report. And today I want to talk a little bit about portfolio diversification. As I mentioned before, there's been some very critical articles about managed futures recently, particularly from Bloomberg, and where they hit upon is some of the high fee structures. But those high fee structures are in retail products that are kind of true across the board of retail products, whether it's an alternative investment as managed futures or a traditional retail equity long only program. And I think one of the damaging things about the story is that compare it managed futures to in the retail funds to an equity program. Now, I think nearly everyone has exposure to equities through a 401k or through an index program. Traditionally, people say you should have 60-40 equities to fixed income, and most people would have something along those lines or more heavy on equities. So you don't have to make the case for equities. They made the case that equities performed better over the past decade, looking from 2003 through 2012. A very fortuitous time for equities because you picked it from the bottom and you missed that huge bear market. Obviously, you need to look further back, and if you'd include 2000 and stop maybe at 2009, it would be a huge different story. But the point is, you need a diversified portfolio. So if you have equity investments, if you have 60% of your portfolio in equity, it makes no sense to say, geez, these products didn't perform well. The other point I want to make is that they kind of the negative stories lumped managed futures all together, but they're really looking at a small subset of funds, which is, I don't know, maybe 5% of the industry. The good news is, while many separately managed accounts have very high minimums of $1 million or more, you can find very strong managers with lower minimums of 50,000, even below. And that's particularly true in the option space. And the interesting thing, as I mentioned before, in the option space is that there's been a kind of a growth in that space, so you don't have just a group of pure option writers that tend to do well most of the time and they get hurt in a spike in volatility, which, by the way, people are fearing right now. There's a more holistic approach where people are long options and short options, and some of them actually are biased towards the other side, so they could actually earn profits through long options in some of these spikes. So they're much safer. You can get in there. I've seen some at 15,000 minimum, 25,000 minimums. You're not paying a higher management fee in front of a typical 2 and 20. You're paying probably a typical 2 and 20 or 1 and 15. A lot of people, while 2 and 20 is always a sticker price, especially emerging managers have a hard time getting that. So you need that diversification no matter what, especially if you have a traditional portfolio with a lot of long equities. Equities have just made new highs. We have VIX trading at about 12.5. While if the Fed continues, there's expected that there could be a slow grind higher, especially as we get towards December, which is typically a good month. With the VIX at 12.5, you're not going to see a huge move in equities. You may see this continue slide, grind higher. You also may see a pretty significant drawdown. And, history will tell you that they're not going to make a big move off a 12.5 point VIX. So you need that diversification. You need to look at managed futures. That tends to do well in spikes market. It just had a good month in October. It's been a bad period for two years. But what we're talking about is diversification. So if you have that large investment in equities, you need some alternatives, something that can do well when equities do poorly, or do well when it's doing good, something that's non-correlated and has the potential of being negatively correlated in a bad stock market, which many think is coming. This has been Dan Collins for Traders Exclusive and the Dan Collins Report. Keep on reading the Dan Collins Report. Talk to you soon.